All right, welcome to The Explainer. For months, it's been the AI party, right? Nonstop. Well, today, it feels like someone hit the brakes. Hard. We're talking about December 12th, 2025, and we've got a serious reality check to unpack.
I mean, just look at the markets. It was a sea of red. And this wasn't just any sell-off. It was led by tech, which has pretty much everyone asking the one question on their minds.
Okay, so as you can see, it was a down day across the board for all three major indices. But here's the thing you gotta notice. Look at the NASDAQ. It got hit the hardest, down almost 1.7%. And that right there is our first big clue. This whole thing started in tech. It was the epicenter of today's earthquake.
So what was the spark? What really lit the fuse on this tech sell-off? Let's dive in and dissect what really spooked the AI space today.
And almost immediately, all eyes turned to one single company, the AI chip giant, Broadcom. You could just feel it. They became the lightning rod for all this anxiety that's been bubbling just under the surface of the whole AI boom.
I mean, just look at that number. Down over 11% in one day. That is a massive, massive drop. But here's the crazy part, the real head-scratcher. This happened right after they reported earnings that, get this, beat expectations. So what on earth is going on here?
And this really gets to the heart of it. It seems like the market's entire mindset has just shifted. You'd think a $73 billion AI backlog would be amazing, right? But it wasn't enough. The expectations were just through the roof. It's like investors are saying, okay, the hype was fun, but now we need to see the proof. Show us the money. We need cold, hard profits.
And if you want proof of how jittery the market is, look no further than this. A report comes out claiming an Oracle data center might be delayed. Now, mind you, this report was debunked almost immediately, but it didn't matter. Just the rumor was enough to send these shockwaves through the entire AI supply chain. It just amplified that nagging fear in the back of everyone's mind. Hey, maybe this AI build-out isn't as solid as we thought.
Okay, but here's where the story gets really interesting. Because while all the big tech names and AI stocks were getting absolutely hammered, something else was happening just beneath the surface. This wasn't just a panic sell-off. Nope, it was a rotation.
And this chart, wow, it just lays it all out, doesn't it? Look at the IT sector, down almost 3%. You can literally see the money just flowing out. So, where'd it go? It found a new home in these safer, more defensive sectors like consumer staples, which, believe it or not, ended the day in the green.
You know, there's actually a term for this. It's called rally broadening. It's basically what happens when a rally, which was all focused on just a few big names, like tech, starts to, well, broaden out. It spreads to other parts of the market. It's a sign that investors are starting to feel more confident about the whole economy, not just one hot sector.
And the big players on Wall Street are definitely paying attention. Goldman Sachs, for example, is actually calling this a really healthy sign. They're saying it shows this growing optimism for the wider economy, maybe even a Goldilocks scenario. In their view, the market's foundation is getting stronger because it's not just relying on a few tech giants anymore.
Okay, so let's zoom out a bit, because none of this happened in a vacuum, right? There's always a bigger economic picture, and today was no exception.
What we saw was this really interesting chain reaction, especially in the bond market. So on one hand, you had some folks at the Fed still talking tough on inflation, not ready for rate cuts. But on the other hand, this broadening rally we just talked about, that signals a stronger economy. And both of those things, for different reasons, push the 10-year Treasury yield up. And you know what that does? Higher yields basically put the brakes on stocks.
But here's another really key detail, and it's a bit of a paradox. With all this drama in tech and the jump in bond yields, you'd expect fear to be spiking, right? Well, the VIX, the market's fear gauge, actually went down. That's huge. It tells us that even though people were dumping their AI stocks, it wasn't a full-blown, the sky is falling kind of panic across the entire market.
So, when you put all this together, what's the move? How do you navigate a market like this? It seems like there are really two clear paths an investor could take right now.
It really is like a fork in the road. On one side, you have the aggressive play. This is where you lean into that rotation we saw, betting that the whole economy is on the upswing. On the other side, you've got the defensive play. This is all about protecting yourself from that wild tech volatility and maybe a deflating AI bubble. So if you're feeling aggressive, you might look at something like the IWM, the Russell 2000 ETF. The thinking here is that small-cap stocks could really take off if the economy gets stronger and rates come down. Or there's XLI,
the Industrials ETF, which is a bet on the actual picks and shovels companies building out all that AI infrastructure.
Now, if you're leaning defensive, you might consider AGG, which is a big bond ETF that gives you stability, income, and it could do well if the Fed does start cutting rates. And then you have XLP, which tracks those consumer staples we talked about, the companies selling things we need no matter what the economy is doing.
And so all of this leaves us with the one big question we have to ask ourselves after a day like today. Was this just a healthy rotation, a necessary reality check that actually makes the market stronger? Or was this the first real warning sign for the AI boom, the first crack in the foundation? How you answer that, well, that could define everything for the next few months.